Okay, I'm going to go to a scruff, but I can kind of sum it up with one statement. Now, I'm looking at Luigi's question, and I'll tell you the statement after I've read the question. I'm thinking about the investment concept instead of risk reward, and I was thinking maybe stupidly, because when I invest in some assets, the ROI is 10, 20, 30%, whatever. But when you talk about Forex, the operation is you invest X and you want 2-3 times return, which 300% on your initial investment. How would a system hold up? Well, over time, it doesn't. And otherwise, everyone will be rich. Am I missing something? Okay. Well, the statement that I'll make, which will solve that, is common sense. The higher you go up the tree, the more difficult Forex becomes. Not in what you're doing as a job. Your job should be identical either way. But the money amounts change so much, it affects you mentally. Okay, so it does become harder. So if you're got a small account, you can have massive percentage gains. But when you get high up the tree, the percentage gains come down. So I don't look at the percentages at all. I look at money, period. I'll look to see roughly where I'm going to get in, where I'm going to get out, and I'll calculate as a full position how much that will cost. Now, that is a business cost. And if I agree to that cost, then fine, the trade is okay at this point. I'll then reduce the exposure with DCA. So if I've agreed to the big cost, I'm getting elated with the little cost. So that's the first thing that I'm doing. Then I'm just looking to see what happens on the other side, because the stop has one job. One. Protect the account. That's all it does. It has nothing to do with the trade. And when you start forcing 1 in 3, 1 in 2, and all of this malarkey, what happens is you express your will into the market. Well, if you're going for a 1 in 5 as an extreme, a lot of the time the market won't give you that 5. It'll be very rare occasions. So the argument to it is, well, you've only got to win 3 out of 10. Well, no, what that's telling you is you're shit at your job, but we're going to pay you. Because there's no way you should be getting that wrong 7 times out of 10. If you are, you're gambling, period. And that's kind of the way I look at it. So you ask yourself a common sense question. I know it's going to cost me X amount if I'm wrong. What's the upside to the next barrier? Is there a half decent amount of money in there? Yeah, there is. Brilliant. And then when you've been reducing your exposure when you're wrong, it automatically increases the upside when you're right. So therefore, the two balance each other out. And that's how I approach the market. I look at it from a business concept of that's how much the trade costs. This is what I'm going to get out of it. And do I agree to both costs? If I do, then the return on investment is correct and I'm happy. But if you go down the risk-reward route, which is what is the sales pitch, you'll find it gets harder and harder. And eventually, you won't get anywhere. You'll just be spinning wheels. So I hope that helps. Catch you soon.